Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, August 4th, 2023. It's 2:40 p.m. Eastern Time, and I just wanted to get a video out to and really just talk about where the opportunities appear to be right now. I'll go over some of the things I went over recently, and I'll start out as I usually do with the markets. Then we'll roll into some of the other sectors that I continue to or not just sectors, individual different trade ideas, and that'll be the metals, commodities, the VIX, the market. I recently pretty much positioned short on and called a top on that whole leisure trade. I'll talk on that. That includes restaurants, airlines, everything, services, travel related. And then a new one. I want to go over the home builder sector today. I think there's opportunity there as well. So we'll have some new trade ideas in here. Let me just dive into the charts. This is QQQ. This is a daily chart. I cleaned the board up a little bit. In other words, I had a lot of lines from before. And so these are now the key levels. This is that 60-minute, well, it's here on the daily. We're looking at the daily chart now, but that uptrend line / wedge that we broke on the 60 that gave us a sell signal recently. And you can see we have, this was resistance, 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 breakout, and now we're back testing. So this is, to me, a big level, about 372.84, give or take. Remember, on a 372-point security, you've got to give it a little bit of room as far as points go. So that's, a give or take number there. It's all relative because of high price of QQQ. And then this is the BOD, your benefit of the doubt uptrend line. Certainly a valid one. You have this initial reaction back in early March. Couple tags right there, some more tags there, and this is where we've been bouncing the other days. So it's really a dual support level, price and trend line, and a break of that will certainly be some zigs and zags along the way, but I think that'll bring us down here from more of a swing perspective. If we get that sell signal, which I suspect we will, that should take us down to about 347. And then, of course, I'll update, maybe add some additional targets. But let's just look at that one for now, and that would be about a 6.5% or so drop there. There's the divergences. Here's what it looks like on the 60-minute chart. Again, I'm going to zoom in a little bit here. There's that same uptrend line, the smaller uptrend line. Oops, that's not what I wanted to do. I wanted a line tool here. And there was our recent breakdown. And you can see, again, we're sitting right on support here. It's about, on this 60-minute chart, I have the line at 372.16. You can see we had that high there, get rejected there again, made a couple runs at it, and finally a breakout, and we're currently back testing. So we've already broken the trend line, and there's a downtrend line. So let me be clear on my thoughts here. Apple and Alphabet, Amazon and Alphabet are out of the way now. So that is the majority of the FANGs. We know what happened. You should know what happened today. Amazon's up big, but Apple, the world's largest publicly traded company, the top component of the NASDAQ 100, the top component of the S&P 500, in addition to being probably the most psychologically important stock. Apple has a cult following in the U.S. Most of you listen to my voice have iPhones and products and all that stuff, and so it's a crowd favorite. And so there's in addition to the mathematical component weighting on the indexes, there is that psychological component to the market and the tech sector as a whole. Widely believed that the market's only going to go so far without Apple. So now we'll get to Apple here. We'll do that in 1 second. Let me just mention again, this is support. So pretty much a break of the recent lows. That's probably would take until next week, unless there's a big late session dump today. Wouldn't surprise me at all, but that may come next week. So let me be clear. I think it's time now that all those earnings are out of the way, the Fed's out of the way. We had the employment data today. That continues. Those numbers continue to soften. It's not a hard roll there yet, but that's one thing I've been watching for that final kind of leg. And that taken in with everything, as I said, just in the last couple weeks, we've had a litany of calls, pivots, if you will, from major brokerage houses and firms, including the Fed, that have now pivoted away from a recession call to saying now no recession. They've abandoned their recession calls, even the soft landing, and that to me is a potential contrarian bearish indicator. But let me make this clear. So I think it is time, and I personally added shorts today on the post opening pop. I think it's time now for me, even though it's a weekend, you got to keep that in mind. You don't want to go crazy long or short, on any one position or any one, core part of your portfolio. But I think at this point in time, for me, it makes sense to increase short exposure, even though we haven't broken that level. And of course, next week, if we do, add to that. But now that the big earnings are out of the way and the market is free to do what it wants, and in other words, I think it's free to let the technicals, the charts play out. We've had a lot of, the market, especially the NASDAQ 100, kind of going into a holding period or, mode lately with the big earnings and the Fed meeting and all that. So, and here's the thing. To me, it's all about risk reward. Where I think we're going is down ultimately to this level here. We had this period of consolidation, a little trading range back that the markets broke out of back here in early May. And that, just to kind of measure it out for you, that's where I think we're ultimately going to zigzag down to, and quite possibly more. That's about a 13.5% drop from where we're at right now. So I'm going to speak, as I always do, I frame all trades in a risk reward perspective. And so, a short here, and again, maybe you want to wait a little bit. It would be prudent to wait till this level goes, maybe next week, maybe today. I think it's coming. So to me, I'm going to go home pretty aggressively short this weekend. That's just what I'm going to do. You guys do what you want to do. But look at the beauty of a stop right here. You have if the Qs happen to rally up here, and we're only talking about 3% or so. Let me measure it out. Yeah, right about a little over 3%. If they do that, they're going to take back this downtrend line, which means this whole thing will be a false breakdown, aka bear trap, whipsaw, whatever you want to call it. You'll also have taken out this downtrend line off the highs. And now, as I did say before, if we pop up, we'll probably go up higher. If we get that far, we're probably going to take out this high. So I think that is a prudent area for a stop. You're limiting yourself to about 3% or so loss. Let's say you have nothing right now. That's all I can speak to. I can't speak to those that have been averaging in, those that shorted this little wedge breakdown that was highlighted here, which are, you're positive right now on this trade. Again, there's numerous entries on a trade, especially when you're trying to call a top. Then you want to scale in or build into that position. And so that would be, again, just an initial short here with a stop there. You're giving yourself an excellent RR, better than 4-to-1, meaning you're risking about 1 unit of loss, or you can say 3 units of loss if you want to talk in percentage terms for if you are targeting down there about 14 units or 14% of profit potential. And, if they pop it up, and then they do put in that marginal new and divergent high, and we get just a bigger wedge, and then we go down. Well, you can always re-enter on another break of the trend line or a break of 372.16. So that's kind of my trading plan, if you will, and I think kind of a generic trading plan for anyone interested in shorting the market or going or individual stocks such as Apple, which I think is a great individual short right now. And let me say this, because I always do. I'm going to be wrong. I'm going to be wrong a lot. There are some of you that are bullish. I've seen the comments that are looking to buy dips. Well, the same levels that I'm looking at highlighting key support levels, like about 372, are levels where dip buyers can step in and buy the dips. When you buy a dip, you ideally want to buy a dip to support, not a random dip just because it's a dip. You want to buy on an uptrend pullbacks to support. So there's a support level. There's some minor support levels here. Here, let me pull up my NQ chart. If you're a futures trader, this is the NQ 120-minute chart I shared with you recently. You have this primary uptrend line, very clean. I really like this chart. You have a nice clean uptrend line that comes off the early March lows. Numerous clean, distinct reactions on that to help validate it, followed by a recent breakdown. So this, all day long, with no ambiguity, is a clean, straightforward sell signal. It may not pan out. Even sometimes the best technical setups, bullish or bearish patterns, just don't play out. But more often than not, they do. That's what this game is all about. You take enough, you take enough of these shots. You line up. Don't try to force a trade. Look for clean, bullish and bearish setups. And that's what this is. So I think it's objective to be short here. There's my target down there, the same level, the comparable level on QQQ. I have these thicker lines right here, as I told you the other day, are the more significant support. So here, my thoughts on that. If you're a typical swing trader, I wouldn't try to worry of gaming any near-term bounces on these shorter-term levels. Probably come down here to that 14,855-ish level, get a reaction there, head on down here, hit that 14,427, and then get another reaction, and finally a more powerful leg down here to about 13,503. That is, as of now, how I think it's going to play out. Now, we do this next week, then guess what? Then this scenario may happen on later over here, but we're probably not going to. If we regain, again, it's pretty simple to me. You have a downtrend line right here off the highs and the primary uptrend line. So if the NASDAQ 100 heads up here, you have a stop somewhere up there, about 3.5% or above current levels, and you're targeting that 14 or so % drop right there. All right, so Apple earnings are out of the way, and this is that 60-minute chart. Here's the daily. I told you recently the minimum target that I have on Apple would be 176.15. So we're now halfway there in just a couple days from when I first started highlighting that. That's its previous reaction high. And so far so good. And again, this is the leading tech stock, if you want to say that. It's $3 trillion. The next biggest company behind it is, would we have Apple or Google? I'm looking at, there's two share classes. You have to add them up both on Google. Either way, Microsoft's only a 2.4 trillion. Apple still has that $3 trillion, which it's actually would probably lose today. Remember back here, we had that kiss of death post when we first hit it on, it was all the way back here on June 30th. This is where the headlines where it became the first $3 trillion company right there. And pointed out how that's often a kiss of death when we hit the 2 trillion and the 1 trillion mark. And it made it a whopping, this was the highest close right here on Monday. And that was a mere 1% above the highs on that day right there, almost right where we were. And then you can see what's happening here. So that is a sell signal all day long. And more importantly, to me, much, much more importantly, okay, I always talk about this, that, as an active trader, whether I'm day trading, swing trading, the shorter term time frame you're trading off of, you can go down to 1-minute charts, 5-minute charts. That's the realm of the day trader, very short term in and out trades. Swing trading, I typically like 15, 60-minute charts, daily charts. And the shorter the time frame you go down to, the quicker the buy signals are going to come and the sell signals. They're going to get you in sooner. But what I've learned is you have a higher rate of whipsaw. So that's why sometimes we'll often say, when you're shorting a breakdown or going long a breakout, you can take it on a break of the trend line, or you can wait till the candlestick closes on that period. And what I mean by that, if it's a daily chart, then you have to wait till 4 p.m. that day. In this case, it's a weekly chart, and so you wait for the weekly candle. And so, again, that all makes sense. If you go out from a daily to a weekly, now you get fewer buy and sell signals waiting for the confirming weekly candlestick close, 4 p.m. on a Friday. But those signals have a much higher rate of playing out. And this is that chart I gave you last night of Apple. This is the weekly candle. So when we look at this trend line, it's very well defined, very clean. This is uptrend line I've been following for months now on Apple. Very well defined. The last few weeks we were flirting with it, but they're green candles. We closed each one right back on. Even intra-week dips, we closed on it. Even last week, boom. That is a sell signal. This is, this is my, all right, this is it, guys. Yeah, sure, Amazon's rallying today, but Amazon's also recovering. It had quite a dip lately, and I believe that Apple will bring down the rest of the lot with it. What's that saying? It only takes one bad apple to spoil the bunch. Well, this is what we have here. That is all day long a sell signal. I can't promise that or any sell signal will stick. I can promise that's as good a sell signal as I've seen in a long, long time. Let me show you some of the other uptrend line breaks. Clean uptrend line, very similar. Solid red candle, very similar. From there, that breakdown, Apple fell, well, there it is, measured 32%. I'm sorry, the 32 is off this divergent high, my bad. So I'm also looking at this. We have big divergence. This is a divergent high. Last divergent high, 32% drop. Divergent high before that, 39% drop. Divergent high, 34. Divergent high, 45. Divergent high, 62. And then what you see here, this is the long-term uptrend line I have off the '03 lows, 2002, 2003 lows, a very significant secular bull market uptrend line in Apple. And the stock tested it here, rallied, test, recently tested it here. So that is a target. So that's my second target. That's what I gave you last night. We're already halfway or most of the way now to that first target, about 176, that previous reaction high. And then this would be the next stop, this trend line, and that's going to be a drop on Apple if it gets there, depending on if and when it gets there, about 20%, and that's going to put pressure on the market, if I'm correct. Now, this is important. So those are I'll call them minimum swing targets, right? Those two targets. This is a very significant longer-term uptrend line, and this is powerful divergence. This is the biggest divergence I've seen on Apple since back here. And that was a 34% drop, 39. And then it's comparable to this divergence here where Apple dropped 62%. However, if this divergence plays out even for a half decent correction, comparable to these other ones, these 30+%, it has the potential to take Apple down below that long-term trend line. And these divergences could play out for a much bigger drop. You can see right here, I think you can see in the video, we're poised to make a bearish crossover on any more downside. Again, it's a weekly chart. Let's just take a look. Remember, this is what I call a high-level bearish PPO crossover. High level meaning well above the zero line, which is this dashed line. So you have one there, and you had one right here that coincided with this trend line break perfectly. That sell signal took us all the way down to this point, and it came right after this divergent high. So you had a divergent high, trend line break, bearish PPO crossover, wham, bam, bam. You had a high-level bearish PPO crossover here, and you had a double-digit drop. High-level bearish PPO crossover right there in conjunction with the trend line break. That was a drop of about 35, 36%. Okay, so there's a lot of reasons, in my opinion, to be short right now. The rest of the world loves Apple. It's a correction to them. They're buying this dip. To me, this has the potential to be quite a bit more based on, again, I'm going off a weekly chart here, and I'm looking at similar technical conditions, not just one thing, not just the divergence or the overbought conditions, but the bearish PPO crossover, the trend line break, everything else. And that tells me we're looking at most likely a high double-digit drop in Apple that's probably going to last, be measured in weeks, if not months. Possibly even more. So that's that. I don't want to spend so much time talking on one stock, but it is Apple. It is the top component of the S&P and the NASDAQ 100, and it's most likely going to rain on Alphabet's or Amazon's post-earnings party. There's Amazon, which is still, well above its previous bear market highs as well. Just having a good day today. But what happens with all these stocks is, remember, I did that checklist. I don't have it in front of me now, but the majority have crapped out after earnings, trading down. Tesla, Alphabet, and those that haven't, I think, will soon join the party, like Meta, and continue to put pressure on both the indexes, NASDAQ 100, S&P 500, as well as the tech sector. You still have things I like the semis. Semis also still flirting with that key support right there, 507, coming off that divergent high, moving lower, still targeting a move down. This was the move right here down to this uptrend line, and first target here about 482. So they'll come in right now. That target would come in together right about here. Again, 482, 50-ish plus the uptrend line. I'm talking about this uptrend line. So still a sector, plenty of meat on the bone. And again, because of these divergences, we can go down there. That's my initial minimum swing target. If we break that, it's going to open the door for a much deeper correction there. Let me give you some new trade ideas. Just a quick update. Somebody asked, I saw a question about the, I think it was LUV Southwest. And remember, one of the sectors I recently became bearish on, gave you a bunch of short trade ideas and called a top on, is that whole really the whole service sector, and this particularly the leisure sector. All these airlines, vacation, people taking vacations, spending money, going to hotels, taking cruises, going to casinos, that whole thing. That's where I'm targeting. I think there's a lot of opportunity there for a major top, and that includes the airline sector. So, but I covered that in one of those videos, at least one or maybe both of them last week. XAL is the airline sector. So somebody asked about Southwest. Well, the airline sector, as I pointed out before, ran into big resistance here with negative divergence, and it's already down. It's been falling sharply. So it's safe to say that the airline stocks are descending. However, they're coming up on support. So there's going to be most likely a technical bounce here. So to be very clear, I don't think it's an objective short anymore. It was a week or two ago when I started highlighting it, those stocks, but we're now coming up on really good support. That good support is right here. XAL, again, this is the airlines, Amex airline index, and we're coming up on that support. Now, do I think we go lower? Probably, and probably come all the way down, back to this trend line, come to this uptrend line right here as a long-term uptrend line. It's just I think there's better fish to fry at this moment. So LUV was the one that I was asked about. Here it is. There's the primary downtrend line. It's already back testing its comparable trend line. Remember, we're coming off this divergent low. They had a nice rally. It was a breakout, ran right into this resistance, 39.62, back testing, but it's also back testing the trend line with some price support there, minor price support about 32.10. Now, the breakout fails. That's going to be very bearish. That's going to be a false breakout, and then we'll probably run at that previous reaction low and continue even lower. But as of now, if I had to do one or the other, I'd buy LUV or Southwest for a bounce because we're pulled back to support. But I don't have to do anything. That's the thing about it. So I'm not taking a position, and I'm just giving you an update. And it's also, you can see these 200-day moving averages, the red and blue lines, tend to cap the advances. So you're in a bull trend when you're above them. We took them out there, but we've now fallen back below the 200 simple and exponential. And so that's a failed breakout above the 200s right here. So if we go much lower, we're also going to fail back below the trend line. So just one to watch, in my opinion. And again, one that I wouldn't short now because it's already dropped too much. It was a short here a week or so ago, but coming up on support right now. All right, let me give you a new sector. Before I move away from the markets, hold on, because I was just covering the, let me just finish the markets real quick. Remember the VIX, told you recently broke out. I highlighted it before it broke out, and then afterwards above this 60-minute bullish falling wedge pattern. This is the spot VIX breakout. And the other day I said, look, I was expecting a bounce in the market when we hit that. So I said, you probably won't want to buy it now. VIX may hold up, but if you can get a pullback, great. And that's what we did. We pulled back, back tested, and moved back up here. So that's the VIX. Now, you can't trade the spot VIX. You can trade VIX futures, options on those futures, or the ETFs or ETNs that buy the VIX futures, such as this one, VXX. And this is the one I gave you the other day. So breakout, perfect back test. And so, and moving impulsively off the back test. So next week we should hit my first target, rough targets, about 28.80, 31.64, 34.82. And, if that current max target that I have there is hit, that's going to be about a 65% gain from where we're at now. If you bought the back test today, which was a very objective entry, that'd be about an almost 80% return. If that happens, again, it's going to coincide with what I believe is a quick rush for the exits in the stock market. A lot of those FANG stocks, I think we'll probably run up to this target pretty quickly if I'm right. And that could happen, as early as the end of next week. That would be, a 34% move. Again, we'll see what the market does. If it holds up and regains those breakdowns, I should have showed you SPY as well. If you want to watch SPY, this is my 60-minute chart of SPY. Put in a divergent high. I mentioned this is support on the last update, 451.44 in this little trading range here, or not trading range, a thin zone that we entered. And so we're probably going to go and backfill that thin zone. And then ultimately, I think the SPY at minimum, again, minimum target in the coming weeks here, if this all plays out the way I suspect, is this uptrend line right here and the 418.29 level. So that would be a pullback target on SPY, which still has another 6.5% downside if hit. So we'll see if this market can hold up and power on through, and Apple buyers step in and buy this dip and somehow get it back above that weekly trend line. But that again, to me, is a very good sell signal, and again encourages me to be go home short this weekend. Pretty heavily short. And there's your divergent high on ES. ES are the S&P 500 E-mini futures. Nice clean up trend line. Just like QQQ, you had the smaller wedge that broke first. There was our divergent high. Really, really good price support there at 45.58 or so. You can see boom, 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 bouncing, gave it up. This was a break of multiple supports, both very good price support and the primary uptrend line off the May lows. And now we are at my next target, 44.96. As I do this video, we're right there. We'll call it 4,500. Yeah, round it off, and that's where we're at now. Remember, it's a 4,500 point index, so that's, for all intents and purposes, that's 4,500. Big level. Certainly, the potential the market could rally next week. You've got some potential positive divergences here, but if those divergences, if we break down and head on down, which I suspect we will, those divergences will get taken out, and that's very bearish. And remember, we're coming off that big divergent high, so that's a level to watch. So pretty much where we're at right now. If we go much lower, it's going to break that support on the S&P 500, and then the VIX should run, the Nasdaq should move lower, and et cetera, et cetera. Let me give you one other sector. I'll try to keep this video relatively brief. Love to get it out to you in time before the close. So I have a new sector. Okay, so the service sector I recently started, getting bearish on and sharing a bunch of trade ideas, and some of those were set up, some were actionable, and it's a sector I felt confident enough to start already engaging, and it's been moving lower, especially the restaurant stocks. Remember, that's where I started out. EATZ is your restaurant ETF. So far, it's probably about when I highlighted about a week or so ago, it's already dropped about 5%, and most likely heading lower. I gave you individual trade ideas like McDonald's. There it is. Boom. There's that break of the 290 level I wanted to see for the next sell signal. So this one's playing out. I gave you a bunch of these: Starbucks, Chipotle, Yum, YUM. What else do we have here? Let's see if there's any moving today. Red Robin Group, that Head and Shoulders, potential Head and Shoulders, still moving lower. And but let me give you a new one. Home builders. Okay, there's two ETFs. Let me keep it simple right here at the beginning. If you don't like individual stocks because you don't want to navigate earnings season or take the additional risk, you have two main ETFs for the home builders. XHB, that's the Spiders S&P Home Builders ETF. Home builders at all-time highs. The narrative on that has been, with the rise in rates, sharp rise in rates, there's very limited inventory on the market because the majority of people, just anybody who bought a house, other than in the last year or so when the Fed started raising rates aggressively, everybody for the last 10 plus 15 years is locked in at 3.5% to 4% mortgages, super low rates. Sometimes less, 2.5%, 3%. And so unlike normal points in time where people have become empty nesters, downsize, sell the home because they don't need 5 bedrooms anymore and buy a smaller home, and it helps fund their retirement, they're stuck. They can't sell, it will not make a profit, or come out ahead by getting rid of that 3% mortgage to trade in for a 7.5% mortgage. So that's the narrative. But what happened is it actually played into the home builders very well because they started ramping up new construction and to meet that supply, and so they've been a beneficiary. However, I've been reading up on this lately. What they've been doing recently to continue to move, they've been facing a lot of pricing pressures. They weren't moving homes. They've been discounting the homes steeply. However, not in price, because if they start slashing prices, then it has that spiral or domino effect, and the prices on their other homes will start going down, and you get that vicious cycle going. So what they've been doing is subsidizing the sales of the homes by giving incentives such as buying down rates. To buy down a rate, if you've ever done a mortgage, you can pay points, money up front, to purchase a lower rate. And that's what they've been doing, which is effectively, it's cutting into their profits. I'm sure it'll show up soon. that they've been making these concessions in order to continue to move their inventory. And then the next stage is, experts that I've been listening to believe we'll start to see a lot of homes. There's been a lot of homes held back off the market by individual investors, and we'll start to see that tick up. And then once that happens, the home builders are going to be in trouble once if the market does start to get hit with a lot more supply from existing residential properties. So something to watch. Either way, those are my fundamental ramblings. Let's just talk technicals. Clean up trend line, negative divergence, bearish rising wedge. Breakdown the other day, and we're still below there. That's XHB. ITB, I think, is a little bit more of a pure play on the home builders itself. What I mean by that is they both have some of the top components on both of these. ITB or XHB are the big box stores, Home Depot, Lowe's. Even though they're not home builders, they're obviously beneficiaries of the housing market. And so just keep that in mind that you're going to have those in there. So my preference is on the individual home builders, but let me just show you what's going on. So you have ITB. There's your primary uptrend line, minimum target for me. We just broke down from the minor uptrend line, aka and bearish rising wedge right there. There's our divergence lines right there. Breakdown. So this one's an actionable short trade right now, in my opinion, because we're below trend on both of those. I'm just going to go through a few of the builders. There's Home Depot. I don't have this chart marked up. Here's Lowe's, waterfalling. Beautiful bearish rising wedge, clean up trend line, negative divergence, and it broke down earlier this week, and it hasn't looked back. Since the breakdown, this thing's already fallen about 5%. And so this is the common theme, and this is why I'm highlighting this sector. I'm seeing a rush for the exits on a lot of these. From the ETFs overall, it looks like this sector's holding up. It's still flirting with or right off multi-year or all-time highs, but yet I'm seeing a lot of these guys. And I suspect it's earnings when I look at these and I go through these charts. It appears that you're just seeing a lot of these things get clobbered out of earnings. And I think that's a trend that's going to continue to accelerate. And even those that held up will probably eventually succumb to the selling in the rest of the sector. So there's DHI, big home builder right here, DR Horton. Sell signal to come on a break below this uptrend line, primary uptrend line. The last one was Sherwin-Williams. Big paint company, most of you are familiar with. Let me tighten that trend line up, make it a little cleaner. So sell signal coming a break of that. Lennar, another big home builder. There's your primary uptrend line, sell signal to come below that. So see, some of these have broken down, some haven't. But those that haven't, like Lennar, big divergences tell me a big correction's coming and move down to at least that 109.40-ish level. NVR, another construction, residential construction. BLDR, Builders First Source. Look at that beautiful price channel. So consider these. A lot of these are trade setups. They haven't triggered yet. I do think the sector's about to roll, but if you want to play it safe, set alerts on these, especially the ones I'm starting out with. When I go through these sector ETFs, I always start out, I sort the components by market cap. So you had Home Depot and Lowe's at the top, then Sherwin-Williams, DHI, Lennar, and so we're going down the line. And the more of those, especially those big mega caps that break down, the more check marks you get to short the sector or the ETF. So there's your price channel. Break of that price channel should bring us down to this more significant uptrend line, which is about, depending if and when we get there, about 17.5% lower. PHM, Pulte. Boom, sell signal to come on and break of the trend line. It's still an untriggered trade, but again, I think we could start to see a quick rush for the exit, especially if you set alerts on all these. You're going to see they'll probably all be going off within the same, very close proximity, within the same week. Quite a few will probably trigger on the same day, where you'll just see big bars down through the, and if you want to take it, set those alerts. If you trade part-time, you can set things called sell stop orders from your broker that'll automatically short it if it breaks below a certain price point or a trend line. That's called a sell stop order. It's like a stop loss in reverse. Stop loss will close out a position, whereas a sell stop order will sell you and get you short. Again, if you know how to queue those orders in at your broker. All right, there's WSO, let's go, MAS, LII, OC, Owens Corning, Let me show you one. This Tech I noticed today. This is a big residential engineering construction firm. See, this is what I'm seeing more and more of recently. Beautiful, beautiful bearish rising wedge. And then it didn't look back. It closed yesterday here. And what happened is it denied any shorts, anybody watching that pattern, an objective entry because it opened up 17, almost 18% lower today. Already hit, undercut that first target. And this is what I'm seeing quite a bit of stocks doing lately, is just gapping way down below these patterns. So either way, it was priced in technically, and then boom, played out so far. Okay, and the key to investing, whether you're a long-term investor, an active trader, diversification, asset allocation, all that good stuff. This is silver. Silver up nothing big today, but we had that breakout in the euro, and gold's moving up. The euro's moving up. I shared that with you early this morning before the market opened. Euro USD breakout right here. This is a 60-minute chart. Breakout. Back tested this support level 109.374, rallied right into that. And this is, I believe I had that level there in advance when I shared this chart with you recently, 101.389. So it hit resistance, pulled back to the next support level, and we'll most likely get another thrust up, which should bring gold and silver with it. Remember, we're coming off this big divergent low. So this is wash, rinse, repeat stuff. Divergent low, rally. Divergent low, rally. Divergent high, correction. Bigger picture, I still have some concerns because we did put in this big divergent high, and what this is also a bounce off support right here. If the recent lows get taken out, that could open the door for another drop here. I probably should have another line in there right about here. But, the way this works is I believe this will work its way lower over time. But we can bounce before then, and it's these little micro bounces where you can trade gold and silver. There's gold right here, 60-minute chart. Gold's up today, 0.3%. Again, nothing big, but it's at support right here on the 60-minute chart. And not crazy about the chart by itself, but the fact the euro looks constructive near term could give us a little more upside. So these I'm kind of, let's say, a warm buy on, not hard, not a hot buy, just an idea. And these have been good trading vehicles lately. They're not trending hard. They're just kind of back and forth. You can game these little rips and dips. But remember, we're coming off this bigger divergent low right here. We had this breakout, and so gold could continue to work its way up like that. So my convictions are high on shorting the markets and the semis and everything I told you before. SOXX still moving lower, still more downside there. I told you overweighting the tech sector, and especially the FANGs, FNGD, things like that. I think you have more bang for your buck than you do on a broad short on QQQ. This one's holding up today, obviously, because of Amazon, but I bet you Amazon buckles next week, especially if more selling comes down the pike in Apple. Last but not least, let's not forget Treasury bonds. So I've been really harping on these, telling you, I felt like a lone wolf. Ackman, I just read yesterday that Bill Ackman is kind of in the same camp as me and sees the potential for a big surge up in Treasuries, talking about he's short the 30-year right now, saying we could go to 5.5% yield on the 30-year Treasury bond. TYX is the 30-year. That would put us all the way up here. That's his call, just based on where he thinks fair valuation is right there. And he said these things can happen pretty quickly. Again, and I'm going off almost everything I've been reading lately is buy bonds. And, interest rates have peaked for a while. They're going to go down. Bonds are good buy, even long-term bonds. And again, this would be, if I'm right, we've now broken out. I can tell you I've been right so far that this was big resistance and we broke out, and that's a pretty big move in the 30-year bond yield right there. And so that was a breakout, is a breakout unless it fails, right? And then we have an uptrend line here. So if it stays above, especially that 40.33 level, And if we can take out, we ran up, tested these previous highs right there. So, I told you before, we were within spitting distance of new all-time highs and multi-year highs, at least in the 30-year yield. And we came very close to yesterday. Yeah, a little pullback today. But again, I always say I can't promise anything in trading and investing, but I can all but guarantee that if we run up there, and again, I'll just use Ackman's target because I think on a breakout, we would probably see a lot of stops being hit on the Treasury bonds. And what you're saying, stops hit, remember, this is the yield. The inverse of this is the 30-year bond, which is the price of the 30-year. And so this is TLT. I'll turn off all the lines here. Although, no, let me turn them back on. Because remember, TLT has the comparable where you had resistance on the 30-year yield. That's support right here. 1, 2, 3. A lot of taps on that level. Big support level. We briefly went under it there when the market was going down before. Now we broke down. And so what'll happen if we go much lower, you're going to have, I believe, a lot of stops being hit. And because the vast consensus is the rates have peaked, you're going to have that quick paradigm shift. You're going to have loss prevention from the big hedge funds and all that. They have a lot of treasuries, things like that, hedge funds, institutional investors. And so if we take out if we take out probably yesterday's lows in the 30-year bond, and then these previous lows back here from October. Remember, I talked about that not being mere coincidence. That's when the stock market bottomed mid-October, and that's when the 30-year bonds yields peaked and bond prices bottomed. So a break about below that level is going to be very significant and will most likely rock the markets, in my opinion. And again, the further we go down, then the more impact that's going to have on the stock market. So I wanted to leave it at that. Keep an eye on that. The 10-year and the 30-year, the 10-year IEF, if you're looking at the ETF, and that one has this level here, 94.20 is the big level that needs to go. We tested it today. Little bounce, little oversold rally, I think, right now going on. And look, that could continue. You have some positive divergence. So it's really something to watch. It's not an all-in moment to short Treasury bonds yet because the 10-year is holding here, even though the 30-year has broken down. And you're still a little bit off those previous lows. But if you get this, it's probably going to be a pretty bad sign for the stock market, in my opinion. So those are the things to look for next week. And like I said, I'm personally increased some short exposure on the equity markets, tech, all things tech, things like that. Home builders starting to nibble there, restaurants and whatever else. A little bit of gold and silver on the long side to go into the weekend. Wheat, still like that right now. Got a little bit of wheat. And those are the kind of the core holdings. And then, last but not least, keep an eye on crude oil. Again, this is the inflation trade. This is what I call the bane of Powell. Fewer things have more of an impact on inflation than crude oil. And as I've covered, the month of July was almost straight up with hardly any givebacks. Unlike all these other choppy months where you went up a little and then down a little, closed the month a little higher, a little lower. That is a definite tick up we're going to see in the July inflation reading, especially with core. There's your levels there. You can see crude pushing up, and DJP, the proxy commodity ETF or ETN, still moving higher and zigzagging its way higher. I mean, this fact that it's making these higher lows and higher highs so far. So if we see this, that's going to be no bueno for the markets. If we see this, then yeah, that should be a net positive for the market. Should be. Again, with the little caveat being that if we get some kind of big meltdown in the markets, you could see money coming out and you get those broad-based sell-offs where everything gets sold down, demand destruction in crude and all that other stuff. And then, of course, there's natural gas, too. I like a little better than crude right now. Crude's been running, but I think there's probably more upside potential from here in nat gas. All right, I will wrap it up here, get the video out to you, hopefully before the market closes. Let me get it going. This has been Randy Finney with Right Side of the Chart. Have a great day.